Hey guys, I'm Big Mike, and today we have Al Brooks, and this is, I believe, his fourth or fifth time to do a presentation on BMT. Today he's actually presenting from a coffee shop, so we hope that everything goes normal. We'll find out here in a few minutes. Today he wants to talk about probabilities, market timing, and scaling, like scaling in or scaling out, I presume. Also, at the end of today's presentation, we're going to give away 5 autographed copies of your choice of one of Al's 3 new books. And what I'm going to do is ask some quiz questions that Al has put together that is based on the content that he'll be covering today. So pay attention to what he has to say today, and then when he's done with the presentation and we're done with the Q&A, then I'll bring the quiz questions on. We'll pick 5 winners, and I'm going to ask everybody for their BMT username. That's how I'm going to get in touch with you to get the book in your hands. So if you came to this webinar through Al's site and you do not have a Big Mike Trading username, just go to bigmiketrading.com and click on register. It's free. It takes about 30 seconds. And then that way you'll have your username ready in case you're one of the 5 lucky winners. As always, this webinar will be recorded, and I will post it on BMT sometime tomorrow. I will also email a copy to Al, as always, for his guys. That'll be sometime tomorrow. As you guys have questions, you can type them into the questions box, but I'm pretty sure that Al, as soon as I give him mic control again in a second, he's probably going to ask you to hold questions until the very end of the presentation. So give me 1 second, guys, and I'm going to turn Al's mic back on and give him control.
Hi, Mike. Hi, everyone. Okay, great. Okay, well, thank you for giving me the opportunity to speak. I always enjoy talking. Much to the dismay of my daughters, they get tired of listening to me talk too much. I have written a number of books on price action. I'm a price action trader. I've been trading for my own account for about 25 years. And now that my girls are all in grad school, I have time on my hands, so I decided to do some other things like write books. I prepared a video course as well, and I also run a daily chat room. For whatever reason, the computer is going very slow. It may be due to the internet connection. As I said, I'm in a coffee shop, and my internet is down at home. Okay, let me do it this way. Okay. I have 2 websites. One was designed by and set up and run by traders, brookspriceaction.com, and on that site there are articles and free videos of daily E-mini analysis, and they also run a chat room, and they pay me to speak throughout the day about what's going on in the markets, primarily the E-mini on a 5-minute chart. I have a second website, brookstradingcourse.com. I've been talking so much over the years that I decided to put a lot of my slides together into a course. It runs about 27 hours, and it's 53 videos. And it's at the website brookstradingcourse.com, and it's about price action trading. And today what I'll be saying is in large part from that course. Today I'll be talking about a subject that I call the 60-40 rule, and it's pretty much the basis of everything that I do all day long. It's my belief that nothing works all of the time. Everything works some of the time. Anyone who's been trading for any length of time knows that that's true. The key for me is I think most things work 40 to 60% of the time. And that is very important when it comes to trading. Okay, 5% of the time, the market's in a strong breakout, up or down, and the direction is very clear, and there's no decision. You're going to trade in the direction of the trend. You know, for example, when you see something like this, all right, you got a market gapping up big, and then 3 strong big bull trend bars closing on their highs. I'm only looking to buy. All right, so this is breakout mode. 5% of the time, the market looks like that, and when it does, all I want to do is buy. And you know, how do I buy? The pink right here. I buy at the close of strong bull bars. I buy at the close of bear bars. Okay. I buy with limit orders below bars. So when a bar closes, I place a limit order to buy the low of the bar. That's what these blue boxes are. I buy with stops above bars. So when a bar closes, I place a buy stop above the high of the bar to get long. I don't take all of these buys, but if I'm flat and I see the market is extremely strong like this, I'm constantly looking to get back in. And these are the ways that I do it. So 5% of the time, the market is like this, in a very strong trend, up or down. But 95% of the time, it's not. 95% of the time, there's a profitable way to sell and a profitable way to buy. In other words, the market has enough two-sided trading that both the bulls can make money and the bears can make money. And the key is management. I'm going to talk briefly about the trader's equation. And this is the basis of every trade. Every trader, at least subconsciously, thinks about this. They only take a trade if they think they will make money. And there's a mathematical way to describe that belief. You need the probability of success times the reward that you're trying to obtain to be significantly greater than the probability of failure times the risk that you're exposing yourself to. The risk, that's the number of ticks to your stop. The reward, the number of ticks to your profit-taking limit order. And the initial risk, every trader has a different initial stop. So if you're buying, you might put a stop below the signal bar. You may use a money stop like 2 or 3 points below. You may use a stop based on a moving average on some other support level, right? But once the market goes your way, everyone has the same actual risk, right? So everyone's initial risk is different. Everyone has a different initial stop. But once the market starts to go your way, everyone agrees on what the actual risk is of the trade. And I always base profit targets on my actual risk, okay? So what is the actual risk? It's the actual, it's the number of ticks needed to not have been stopped out of a trade. So if you take a trade, regardless of where your protective stop is, the trade starts to go your way, you have to look back and say, what was the number of ticks I had to have for a stop to not have been stopped out of the trade? And that is your actual risk, okay? And what's the smallest reward necessary for a good trade, for a trade with a positive trader's equation? If you know the probability and the risk, you can calculate what the smallest reward you need to have for the trader's equation to be positive, right? So you need a target that is at least as big as that risk, and that risk is, you need a target at least as big as that risk, assuming you have a high probability trade, and your risk is, let's say, 2 points, you need a target at least 2 points, okay? Whenever the probability is not clear, which is most of the time, go for a profit that's 2 times your actual risk. And that will 95% of the time result in a positive trader's equation. So in other words, if you're not in a strong breakout mode and you're taking a trade and you're not sure how probable your success is, just simply go for a reward 2 times the actual risk. Okay? Actual risk, okay? So let's say you see a chart that looks like this, and you see a bull reversal bar, new low. You say, I'm going to buy this, but this bull bar might not be strong enough to reverse that bear bar. So maybe it's not that high a probability trade. Well, if that's the case, then you go for a reward 2 times your risk. But where's your stop? Are you going to put your stop below the low of the signal bar? If I take this trade, I look at it and I say, it looks like we're trying to form a trading range, but we may have another push down or two. In general, when I take this trade, I do not put my initial stop here. I'll use a wider stop somewhere down here. You can say, well, Al, if you're using a wider stop, are you trading smaller? Well, for me, most of the time, I do not. But for most trade, money is fungible. I have a whole bunch of accounts, and I usually try to do pretty much the same thing every time. But for most traders, if their accounts are not very large and they have to be worried about the dollars on every trade, and they end up needing a wider stop, then I think they should be trading smaller. So you could use a stop below the low of the signal bar, but in a situation like this, we could have 1 or 2 more pushes down. I would rather use a wider initial stop. All right, so my initial stop might be somewhere down here. I'm not talking about how to place stops on this webinar today, but I do want to talk at least briefly about actual risk. All right, so let's say a couple bars later, the market does this. All right, I'd still be long because my stop would be somewhere down here. But now, what has happened? Okay, the market tried to reverse the prior low one time here. Okay, and now it's trying to reverse it again. For me, if the market goes above this second signal bar, this becomes a good trade, a strong trade. In other words, the probability, if it goes above this bar, is now 60%. And why is that important? Because once the probability is 60%, I trade the trade differently. If my probability is low, 50% or 40%, I go for a reward 2 times my risk, which was the case over here. But now the market has changed, right? And now the probability is up to 60% if it goes above the high of this bar. So if I bought above the high of this bar, initially my reward would be 2 times my risk, somewhere up here. But at this point, if it goes above the high of this bar, the probability has changed, and I probably will go for just 1 times actual risk. All right. Again, where's my stop? Probably somewhere, down here. Right. At this point, what has taken place? Right. We have a strong bull breakout bar, a 2-bar reversal. This bar is reversing that bar. We have a second entry long. At this point, most traders would put their stop below the low of this bar. Right. Maybe below over here. The traders who bought above the high of this bar, this first signal, right now they would put their stop certainly below the low of that bar. So their actual risk is 1 tick above their signal bar to 1 tick below the low of that bar. And at this point, once the market traded above this bar, they say, yeah, this is probably going to be successful. So probably successful, that means 60% or better that they'll make a profit. 1 times their actual risk is up here. So these bulls are hoping that the market will come up here for them to take a profit. 1 tick below their new stop, which is below that bar. 1 tick above their entry bar, their signal bar, they got long here. 1 times their risk is here. These traders at this point probably have their stop down here as well. At the close of this bar, they probably have the stop down here. They might have the stop below here. If it's down here, they could go for 1 time that profit target. For them, actual risk is now 1 tick below this bar, right? Their actual risk is 1 tick below this bull bar. So they entered here. Their actual risk is here. 2 times actual risk is here. Theoretically, they could scalp out there. To me, that's not enough profit. I would go for more profit. So I would probably go for a measured move based upon the height of the signal bar. Okay, so the traders who bought here, 1 times actual risk is here. They're trying to get out. The traders who bought here, they may go for 1 times the signal bar height in this area, and traders will take profits here. I don't want to spend a lot of time on actual risk, but in general, you'll find a lot of profit taking at 1 and 2 times actual risk, and that tells you that a lot of computers are taking profits based upon actual risk and not upon initial risk, because everyone's initial risk is different. I said that everybody, that 95% of the time you can make money buying, and you can also make money selling. You just pick one or the other and manage your trade correctly. Take a look at this chart. Okay, we have a bear trend, and we have a strong break above the top of the bear channel, the top of the trend line. All right, so at this point, traders are thinking that the bulls have taken control, and they're looking for a major trend reversal. A higher low, which we got a double bottom or a lower low. In any case, once we've had this strong breakout above the bear channel, traders are going to start looking to buy. And here we have a good second entry buy. We have a micro double bottom. The market went down in this bear bar, down in this bar, reversed up, reversed up. You can call it a wedge bull flag. 3 pushes down. 1, 2, 3. Strong bull reversal bar, 2-bar reversal. Higher low, breakout test of the high of this initial signal bar, right? So you get a lot of things going for you if you're a bull, right? Now, I drew in this channel And this looks like a higher low major trend reversal, and it is, right? But if you look back at the past 20 or 30 bars, it could also simply be a trading range, right? A bull trend has higher highs and higher lows. We have a higher high. We went above a prior high, right? But since the trend has turned up, we have not yet gone above a prior high. We have a higher low, which is good, but a bull trend needs a series of higher highs and higher lows. So we do not yet know if this is a bull trend. It's clearly a trading range, right? We've been sideways for 20 or 30 bars. It's also still a bear trend. We're still forming higher lows and higher highs, and we're still working lower. I do think this is an excellent buy setup, higher low major trend reversal, right? So you can buy one tick above the high of this bar, right? So let's say you get long there, okay? In general, you should always take partial profits at the minimum target necessary for a positive trader's equation. So if you do the math and you say, yeah, I got, if I take profits here, it's a mathematically sound thing to do, right? Anytime a trade goes your way to the point that the math is favorable, you have a positive trader's equation, you should always take partial profits. In general, since probability is hard for most traders to determine with any degree of certainty, the trader's equation becomes positive at 2 times your actual risk. You should always take at least some off, let's say half off at 2 times your actual risk. I also have a minimum. If your actual risk is only 1 tick, I'm not going to take profits at 2 ticks. So I always, in the E-mini, want to take profits of at least 1 point. I never scalp for less than a point. I never scalp for less than 10 cents in stocks or ETFs. Okay, so the trade starts to go your way, 2 times actual risk. Once this bull bar closed, you know your actual risk was 1 tick below its low, right? If you bought 1 tick above the high of this signal bar, right, and then you had this strong bull bar, you would not have been stopped out if you had a stop 1 tick below the low of that bar, at this red line right here, right? So your actual risk was from your entry price, this little red line, to the stop price, which is this line, and 2 times actual risk is right there, right? So that would result in a positive trader's equation, and you should always take at least half off once you have a positive trader's equation, 2 times actual risk. So you should always take partial profits there. And look what happened when the market got there. It got a bear reversal bar. That tells you that lots of traders took partial profits there. Now I said that 95% of the time there's a bull case and a bear case. So just as bullish as you are here, bears are saying, lower highs, lower lows, still a bear trend, right? I drew in these lines, and it's deceptive. Just because the lines are there does not mean that all the computers that are controlling the market are using those same lines. There are other ways to draw lines, and you should always be aware of the bear case as well. You can't simply say, lower high major trend reversal, great trade, I'm just going to swing the whole thing up. No, you've got to take partial profits when you have them, especially when you have at least 2 times your actual risk, right? So this is how the bulls look at this chart. However, there's a bear way to look at the chart as well, right here, okay? For the bears, this bear reversal bar is at a bear trend line. So, you have bears who are shorting, betting that we're just forming another lower high and will continue down. It doesn't matter how strong this rally is, right? The bears just see another lower high, and the market's reversing down at a trend line, so they're shorting here. So the bulls are taking profits here, and the bears are shorting here. We have a moving average gap bar, a bear trend. The first bar with a low above the moving average usually results in the final leg of the bear trend. It's possible that the final leg of the bear trend ended here. It's also possible that it's way down here. We don't yet know. But I do know that if I bought at this red line and my stop was here, I'm taking at least half off here. The bears, they're actually going to short here. They're at a bear trend line and a bear trend. And what followed? this is what followed. The bulls would have been stopped out of the second half of their position, somewhere around break even. They may have stopped themselves out below that bear bar. The bears who shorted below that bear bar, they make a profit on the way down. And within trading ranges, that's always the case. There's always a bull argument and a bear argument, and usually it does not matter which side you take, right? There's a way to make both sides work. Okay, 60-40 rule. 95% of the time, the probability of every trade is between 60 and 40%, or 40 and 60%. Every time you buy, there's an institution selling. Every time you sell, there are institutions buying. Okay, since institutions are profitable, I think that's a basic assumption that you have to hold. Both the buyers and the sellers are taking profitable trades, and there's a profitable way to manage both a short and a long trade. There are always firms wanting to buy, and there are always firms wanting to sell, and they both need a way to do it, and that's why the market exists. The market exists for one reason alone. It allows buyers and sellers to achieve their goal. The buyers want to buy, the sellers want to sell. Hey, let's create a market, and both of us can do what we want to do. Okay? In general, buyers and sellers balance each other pretty closely, and that's why the market is sideways so much of the time. And any time there is an imbalance, if there are too many buyers, guess what? The market has to go up to find enough sellers to neutralize those buyers. Anytime there is an imbalance, it tends to get neutralized pretty quickly. Okay. Since I can't run this as a slideshow, for whatever reason it's not allowing me to run it as a slideshow, I'm having to do it by clicking on slides one by one. And so sometimes I click on the wrong slide and I have to go back a little bit. Okay. Direction in the market, 95% of the time, it's not all that certain. Okay. It's never as clear as anyone wants. Buyers, they look at a trading range and they always want to buy a little lower. Sellers, they look at the market, trading range, or a channel, they always want to sell a little bit higher. When the price falls a little bit, buyers get more aggressive, sellers become less aggressive. That makes the market go up a little bit. When the market goes up a little, sellers become more aggressive and buyers become less aggressive, and that pushes the market back down. And the result is that most of the time the market is pretty much sideways, and within the trading range it spends most of the time toward the middle. Okay, in the middle of the range, the bulls see the market as a good value to buy, and the bears see it as a good value to sell. Okay, sometimes they both agree that the price is too low, and the market has to move higher, and it does so quickly in the form of a bull breakout. Sometimes they think the price is way too high, and then the market has to move lower. When both the bulls and the bears agree that the price is too high, you get a bear breakout, and it moves down quickly. And when it's moving quickly, the 60-40 rule does not apply. Okay. I talked about the trader's equation: risk, reward, and probability. Of the three variables, probability, I think, is the most important, and it's the reason why it's so hard to make money. Probability is the source of all emotion in trading, and it results in traders not making fully rational decisions. Beginners end up not taking potentially great trades because they wonder if the probability is not high enough. It also makes them exit great trades too early or too late. Okay. In general, you should just give yourself two choices with probability. You can never know with certainty, right? Sometimes you look at a trade and you say it probably will work. In that case, assume the probability is 60%. When that's the case, go for a reward at least equal to your risk. So if you're risking 50 cents in a stock, go for a reward of at least 50 cents. Most of the time, you're really not that certain, and the probability is 40 to 50% in that case. And when that's the case, go for a reward 2 times your risk. So if you're risking $1 an apple, make sure to go for a profit of at least $2. Okay. Again, if you think a trade probably will work, assume the probability is at least 60%. because it has to be at least 60% for you to think that that the setup looks good. We all swim in a sea of constant uncertainty, and clarity only briefly happens, and it does so in the form of strong breakouts. Most of the time, trading is unclear, and the probability is between 40 and 60% for any trade. Okay. So let's say you take a trade, right? 40 to 50% chance of working. Well, there's also a 40 to 50% that the opposite will happen. All right. So most of the time, there's a valid way for the bulls to make money and for the bears to make money. All right. Okay. Trader's equation. If the probability is not all that great, 40%, and you go for a reward 2 times your risk, you have a positive trader's equation. Most of the time, the bulls and the bears, if they go for a reward 2 times their risk, they can lose more than 50% of the time and still make money. Okay. Institutions, they have advantages over individual traders. They can do things that things that most beginners cannot do. They can enter at any tick during the day. If you look at any chart on any day, let's say a 5-minute chart, the volume on an E-mini, any bar on the E-mini, it's between 5 and 10,000 contracts. It doesn't matter what time of the day it is. It doesn't matter if the market's in an extremely tight trading range. Right? The volume is going to be 5 to 10,000 contracts. That means that institutions are trading all day long, and whatever they're doing, they have a profitable strategy, or else they would not be taking that trade. Right? So institutions can trade profitably on any tick during the day, which is something a beginner certainly cannot do. And they can scale in as the trade moves in their direction. They can scale in as the trade moves against them. They can also hedge in other markets. If they think the spider is stronger than the NASDAQ, they'll buy the spider and they'll sell the NASDAQ, or they'll short the Qs. Right? They have all kinds of ways to trade profitably that we cannot do. All right? Our alternative is to use setups. Right? In general, traders, especially traders starting out, should wait for setups. They should not be trading every tick of the day the way institutions trade. Instead, setups. Setups are always near support or resistance, and they give you a positive trader's equation either because the risk is small. For example, you're shorting at the top of a trading range with a stop just above the top, right? So you don't have, your risk is small compared to your reward. You're planning on taking profits near the bottom of the range. And also, sometimes the probability is high. So when traders are looking to buy near support or sell near resistance, they're either doing so because the probability is high, there's a tremendous reversal, maybe a second entry, or the risk is small compared to the reward. And that's why traders wait for setups. Again, as soon as you have enough profit for the trader's equation to make sense, in general, whenever you have a reward 2 times your actual risk, you should always take off at least half. Because remember, the other side always has a valid case. So if you're shorting and the market falls and it's 2 times your actual risk, buy back at least half of your position. Can you buy back your entire position? Will that still be mathematically valid? Absolutely, right? You've already determined that the trader's equation is positive, so you can take the entire position off as well. But sometimes you get a big swing, and therefore, if the setup has that possibility, it's worth swinging as well. Okay. Should you enter with stops or limit orders? If you're a beginner, you should only enter either with stops or market orders. Right? You want the market to be going your way. If there's a strong breakout and you're a beginner, the probability is very high that the market is going to continue in your direction. You can enter at the market. Beginners in general should not be entering with limited orders. If the market's falling, they should not be buying. If the market's rallying, they should not be shorting. Okay. At the high of every bar, buying on a stop 1 tick above the high of that bar is betting that the breakout above the high of that bar will be successful. Remember, the market can do just the opposite. So when you're buying on a stop at the high of that bar, there's an institution selling at the market or on a limit order at that same price, and that institution is betting that the breakout will fail. When the market looks like it does in green over here, you can enter with stop orders, buy above the high of that bar, sell below maybe this bar or that bar, right, this bear bar, right? However, once the market starts to look like this, stop orders are going to lose, all right? So if you're a beginner and you should only be entering on stops, and the market starts to look like this, lots of overlapping bars, prominent tails, lots of reversals, you just stop trading. And how long do you stop trading? Do you start trading again over here or over here? No, you just stop trading until the character of the market gets back to this, right? Your goal is to make money. And you should wait until the market offers the kinds of trades that allow you to achieve your goal. And if you can only enter on stops, you should only be trading when the market looks like this. And this is for beginners. They should only be entering on stops, and they should only be trading in here. They could sell at the market when the market's falling strongly like that, but they should not be selling on limit orders. For example, they should not be shorting the high of that bar. They should not be buying if the market falls below the low of that bar. Experienced traders who are consistently profitable and strong at reading price action, they can enter with stops, they can enter with market orders, they can enter with limits. But people starting out, they should only trade when the market looks like this. As soon as the market starts to look like this, you stop trading, even if that means for the rest of the day. Most of the day, the charts will look like this chart and the next several charts that I'm going to show. All right. Here, the market sold off sharply, and then it rallied sharply, and then it went sideways. It's starting to channel up. Right. Once you think that it's starting to channel up, it's still two-sided. At this point in the day, you could argue it's still a trading range. Right. Here, you can argue it's still a trading range. Right. If it's channeling up, and you know that it's channeling up, you know it's two-sided, you can buy and sell. In general, you should try hard to take the buys and not worry so much about the sells. On the other hand, if it's doing the opposite, channeling down, right, you can take the buys, but you should really concentrate on the sells, especially at this point. The moving average is falling, the market's spending most of the time below the moving average. You can take buys, but I would really try to concentrate on sells. Up to this point, if you look to the left, the market was really in a trading range, which is the case. Most of the time, you print it out at the end of the day and you say, oh yeah, it's clearly a bear channel. Well, most of the day, it was not clearly a bear channel. Most of the day, it was a trading range, and it was not so clear. For example, look at this chart. Okay, at this point in the day, you say, well, we sold off on the open, but then we rallied very strongly, and then we sold off again, and the sell-off is probably stronger than the rally. Look at these two large bear bars. All right, very little overlap closing near their low. That bear spike is stronger than this bull rally, so there probably will be additional selling. So at this point, you don't know what the market is going to do, but you think it's probably going to go at least lower, at least a little lower in the near term. Then we have this additional bear bar closing on its low. Okay, let's say you want to bet that you're going to get a spike followed by a channel down, right? And that is a rational bet. So let's say you sold the close of this bar, taking a chance that we're going to get good follow through and channel down. You know that we went down, we went up, we went down. We could also be in a trading range, and you could be shorting near the bottom of the range. However, it is reasonable to take this short, right? But if you do, you always have to be aware of the opposite. Okay? If ever you take a short based on the theory that the market is going to be in a strong bear channel, all right, and then it starts to reverse up, you have this one reversal here, then a reversal here, and a reversal here, all right? You have to think about getting out of your short, and you have to start considering the possibility that your theory is wrong, or that your premise is wrong, that we're getting way too much two-sided trading to be holding shorts near the bottom of this. We might be channeling down, but we're getting way too much two-sided trading. In general, if ever I take a position, a short, and a high 2 triggers, I exit my short. So had I shorted this close, we have an attempt up here, reversal here, and then a second attempt up here. So this is a small high to buy. So to me, I would either go long or exit my short above the high of this bar, right? If I did not do that, if I decided to give the market more room on the upside, and I held and the market sold off here and started to turn up again, I definitely would have gotten out above the high of this bar, right? If ever I'm in a position, a short, and a high 2 triggers, I want to get out, right? Because to me, I assume I'm wrong, and I get out. So I would either get out above this small high 2, right? 2 pushes down, 1 and 2, so 2 reversals up, or I would get out above this larger high 2. But there's no doubt in my mind that had I shorted that bear close, or had I shorted anything in here, and I got this, I would get out, because my premise that the market's in a strong bear trend at this point is not likely to be true. Okay, let's say on that same chart you did not take the short, and you decided that maybe it's going to be a bear channel, but we have enough two-sided trading in here, so it might also be a trading range. I'm going to approach it as a trading range. So instead of taking shorts, like shorting the close of that bar, you wait for a buy signal. Here you have a micro wedge, 3 pushes down, there's 1, there's 2, the second bear bar, this third bear bar is 3, and you basically have an IOI type of pattern. Yes, the O, the outside, is 2 bars, but it's basically an IOI, basically a high 2 second signal, a good-looking bull inside bar closing on its high. I think you can make a case for a buy here. Would I swing? No, because to me this long is not based on the premise that the market's in a bull trend, right? It's based on the premise that the market is in a trading range. I think it's way too early to be looking at this as a bull trend. If I'm buying in a trading range, in general, my rule for a trading range is buy low, sell high, scalp, right? We're low, so I want to buy, and I want to scalp. So if I take this long, I'm looking at the long as a scalp. However, right, anytime a low 2 triggers, right, if you're short and a high 2 triggers, in other words, the second reversal up occurs, I get out of a short. If I'm long and a low 2 triggers, I get out of a long, right? So is this a low 2? Well, we got a double top with this high and this high. So I think it would be reasonable to get out below this bull bar, certainly below that bear bar. It's also a triangle. There are 3 pushes up. The market went up on this bull bar, and then went up on this bull bar up to the tail of this bear bar, so 2 pushes up, and then up here for a 3rd push. Does it have a great shape for a triangle? No, but it's still a triangle. You know, most patterns do not have great shapes. So for me, had I bought this, and if there was not enough room up here for a scalp, I would get out. If I'm buying in a bear and a low 2 triggers, I would get out. If I were flat and a low 2 triggers and a bear, I very often go short. And that's one of the reasons why low 2s are such reliable patterns in bear trends, right? Because most of the bulls will get out if a low 2 triggers, and they will not buy again for another bar or 2, and therefore if a low 2 triggers, here there's a low 2, a double top, so it's a low 2, it's also a triangle. It's a reasonable short for a scalp. Okay. I want to show this chart in a different way. Okay. Another general rule. This is that same chart that I've had up for the past several minutes. Okay. At some point in here, you have to start thinking it's not a bear trend, it's not a bull trend, and therefore it's a trading range. Once you decide that it's a trading range, if you're an individual, you have to buy low, sell high, and scalp. So what's low? As a guideline for me, I look at the prior leg and I try not to take trades in the middle third of the prior leg. So here's the leg up. Okay, the middle third is this gray box. So market's selling off, so I want to buy. I don't want to be buying in the middle third of the prior leg. So I would not buy up in that gray box. Okay, on the way down, okay? The market's starting to turn up again. Middle third of the prior leg, I don't want to be doing much in that area, okay? The market's trading up here. I certainly don't want to be doing anything in here. So I usually avoid trades when the market starts to reverse. I avoid trades in the middle third of the prior leg. Institutions, are they buying and selling in here? Yes, they're buying and they're selling, right? There are institutions that are buying for whatever reason in here, and if the market quickly goes up their way, they'll take their profits, and they're fine. If they buy and it does not go their way, they'll scale in lower. If they're bearish and they sold in here, well, guess what? If they believe the day is a trading range day, are they going to get out right here? Most of them will not. They'll add on higher. They'll add on the close of strong bull bars. They'll add on below bear bars. They'll add on for all kinds of reasons. So the institutions are shorted here will sell more here. Market comes back to their entry price. Well, guess what they're going to do? They're going to get out break even at their first entry, and they're going to get out with a profit on their second, right? And that's part of the reason for this little bounce in here. The bears are buying. They're buying to exit their first entry, and they're buying to take profits on their second entry. Individual traders, I think most traders cannot do that. I do scale in pretty much every day, at least once or twice, but it takes a lot of practice to do that. I personally would not have taken this short, right? But I might have sold above the high of this bear bar and then sold more below the low of this bear bar. That's something I might have done. Okay. In general, avoid trading in the middle third of the prior bar. Once the market gets below the middle third of the prior leg, once the market gets below the middle third, you can start looking to buy here or here. Once it gets above the middle third, you can start looking to sell. Okay, middle third of that prior leg, you can start looking to sell up in that area. So buy low, sell high, and scalp, and try to avoid the middle third unless you're able to scale in. And certainly traders starting out cannot scale in. Institutions, they can. If you look at the volume of all the bars inside the gray box, the volume is pretty much the same as the bars above and below, right? That tells you that there is a lot of institutional buying and selling within those areas. But as an individual, it's very hard for you to make money trading in those areas unless you can scale in. So if you're selling right here, right, and the market goes up there, what are you going to do when the market starts to come down? You'll probably get out break even, or you'll even get out right here. Thank you, God, for letting me out without too much pain. All right. So the only way you're going to make money taking trades within these gray areas is if you have the ability to add on as the market goes further against you. So in general, avoid trading the middle third of the prior leg in a trading range day. Trading range day, everyone wants the market to get a little bit lower. They want to buy low. Everyone wants the market to get a little bit higher. They want to sell high. The reality is the market spends most of the time in the middle third. So most of the time you're waiting. Tight trading ranges, okay? When trading ranges are very, very tight and the swings are very small, lots of overlapping bars, very prominent tails, very small bodies, this is deadly to enter on stops, except in one circumstance, right? So in general, once you start to see this, you should just stop trading and wait until the character of the market changes. The only time you can take a stop entry within a tight trading range is if you get a small bull bar near the bottom, you can buy for a scalp, or a small bear bar near the top, you can short for a scalp. But most of the time, you don't have it, okay? You got bull bars making you buy at the top, a loser. Bear bars making you sell at the bottom, a loser, all right? But rarely you'll get a small bull bar at the bottom or small bear bar at the top. In general, tight trading range, don't do anything. This is not a stop order market, it's a limit order market, right? Experienced traders, they're buying below the low of the prior bar, they're buying below swing lows, right? Market drops below this bar, they're buying, okay? These green boxes. Market goes above the high of the prior bar, they're selling these blue boxes, right? And they're also willing to scale in. You can say, okay, this green box here, you bought the low of this bar, okay? but you didn't have enough room for a profit, and now the market does this, you're screwed. Well, you are and you are not. If you know what you're doing, you're not. So let's say you bought the low of this bar, right? This is the E-mini 5-minute chart. Your plan might be to buy more 1 point lower and buy more 1 point below that, and maybe risk 4 or 5 points, right? Your stop may be way down here. So let's say you bought this low, you bought more 1 point lower, you bought more 1 point lower, okay? And so you bought twice during this very big bear bar. During that big bear bar, what are you thinking? Are you thinking, oh, it's going to rally quickly from here? Or do you think, after the size of that bear bar, it probably has to go more sideways to down, and I want to scratch my entire position? In general, when I see something like this, I'm filled here on a second long, filled here on a third long, I'm thinking that's a strong enough bear bar. We probably have to go more sideways to down. At that point, I'm looking to get out, break even on my entire position. What's break even? It would be this blue line where I put on my second position, right? So I bought some here, bought some here, bought some more there. My average entry price is right there. I would try to get out there. And you can see that a lot of traders did just that, right? The market went right around to that price and fell down a little bit more. Again, you should not be doing this if you're starting out. Okay, let's say the market is continuing down, and you're saying, yeah, it's trending down, but it's not all that strong. Lots of overlap, probably still mostly two-sided trading. The market fell below this low and had some buying. It fell below this low and has a pretty big tail on the bar, and it's followed by a bull bar. Is there any way to make money on this? Well, there is. Okay, again, not something that you should be doing if you're starting out, but with experience, you can say, okay, if I did not buy as the market fell below the prior low, right? Every time it fell below a prior low, it found buyers, right? Right? Okay, that's been the nature of the day. And I would assume that it would continue that way forever and ever and ever until I see evidence that I'm wrong. So I do think it's probably okay to buy the low of that bar. But if you did not buy the low of that bar and then you see this bull inside bar, what are you thinking? Are you thinking, oh, we're converting into a strong bear trend, I'm going to short below the low of the bar? Or are you thinking, traders keep buying low, and we keep getting tails, and we keep getting reversals at new lows. This is a terrible signal bar for a short. Therefore, I would never short below the low of that bar. Okay, if you would never short below the low of that bar, what does that tell you about opportunities? It tells you that, well, instead of shorting, place a limit order to buy the low of that bar. How much do you risk for a stop? Maybe somewhere down here. You can look at how far the market fell below the prior low here, how far it fell below the prior low here, and place a stop a little bit more than that. So maybe down here, maybe right here. You can do a stop below this low if you wanted to use a tight stop. But anyway, you could say that's a terrible sell signal below the low of this bar. So instead, you place a limit order to buy there, and you get filled here. The market starts to turn up. Your entry is right here. If your initial stop is right there to a new low, 2 times your initial risk is 1 time, 2 times, right there. Okay, so 2 times that risk, you and everyone else in the world took profits, and that's why the market sold off. Right? Can you get out with just a 1-point profit, given that your actual risk was probably only a tick or two? Yeah, you could get out with a 1-point profit if you wanted to. But buying at the bottom of a bear channel or a trading range, it should come up to the middle of the range somewhere. So I think it would be okay to try to take profits a little bit more than 1 times risk, maybe at the moving average, maybe at 2 times risk. One final series of charts that I want to show. Okay, market's in a bull trend. We had a strong bull spike and then a channel, a little bit parabolic move. Still arguably forming a low, higher low, higher low, high, higher high, right? So it's still a bull trend. It's clearly a trading range. But, there are different ways of handling this. You could buy at the market and says, say, it's a bull trend. I'm going to buy at the market, and I'll put a stop below the most recent higher low here, or maybe below here. That's valid. But you could also say, it's a trading range, but look at this trading range. Look what's happening here. There's something subtle going on. We have a low, and we have a lower low. We have a high, we have a lower high, we have another lower high, and in fact, this high is even below that high. So something's funny about this trading range. It's a trading range, and it's a bull trend, but it's also a bear trend. We're forming lower lows and lower highs, and therefore, you could short and take a chance that you get a bear breakout and a reward at least 2 times greater than your risk, right? So even though it's a trading range and a bull trend, it's also a bear trend. So if you shorted there and taking a chance that it's a trading range and you got this breakout, what do? You can argue 3 pushes down, possible parabolic wedge, still a series of higher highs and higher lows. So the bulls could buy here. I think, I personally would not. And the reason I would not is for a couple of reasons. First of all, you get these 2 very big bear bars, and this bull bar, the body is not big compared to those 2 bear bars, and it has a tail on top. So to me, this is not strong enough signal bar to overcome these 2 bear bars. So I would not buy for that reason. Also, you have a surprise. A surprise means a low probability event. Anytime the market does something that appears unlikely, it usually will have at least a second push down. So for that reason alone, I would not buy that. Okay, market sold off a little bit more. Now we have a micro wedge. We've got 3 little pushes down, 1 and then 2 on this tail, and then up and then down. So we'll probably get some kind of a bounce here. Is it still a bear trend? Sure. Is it still a bull trend? Arguably. So you will have bulls buying here saying, we're still above the prior low. We got a small micro wedge or a little double bottom. The market went down on this bar, then up and down again, and now another bull body. So you'll have aggressive bulls buying here, right? So it's possible the bulls would buy. The swing bears, they're probably still short with a stop above the high of this bar. To me, had I shorted for any reason up here, I certainly have a reward at least 2 times my actual risk. I would get out of at least half of my position. Okay, so what happens right here? All right, the bulls, they're happy. 2-bar reversal. The market went down here for a bar or 2 and up here for a bar or 2. So maybe the market is reversing up. Still another higher low, right? So the bulls who bought here or even right here are happy betting that the market's going to go higher. If you buy right here, your initial stop is below here, which is far below. This is a weekly euro versus the dollar forex chart, right? So that's a huge distance for a stop. So if you do buy this close, your stop is way down here. However, this is also a sell setup, right? Setups are not always what they appear to be, right? I mean, sometimes you're thinking a sell, I need a bear reversal bar. Well, in fact, a lot of the bears will look at this and say, well, great, this is probably a bull trap, or at least the math is good for it, so I'm going to short this close, put a stop above this high, right? So that's my risk, not very big, betting that we'll get a new low. So my reward is more than 2 times my risk. The logic is good. We're forming lower lows and lower highs, and therefore, to me, this is a sell setup. Just sell the close of this bar. Most traders don't like to sell the close of strong bull bars, so they would wait to sell below a bear bar. Okay. So here we have a 2-bar reversal, all right, and another lower high. So they might sell below the low of that bear bar. They might sell below the low of this bear bar. All right. The bulls, they're still long, betting that the market is going up. Had they bought this close or above the high of this bar, they've already taken at least half off. Right? They may get out of everything after this additional lower high with the 2-bar reversal, but they certainly would have made at least a little bit on the scalp up. The bears, if they were short initially and are still swinging part with their stop above this high, they're happy. They're still short. Had they shorted the close of this bull bar, they're short. Had they shorted below the low of this bear bar, they're short. So right now you have bulls who have a rational reason for being long, and you have bears with a rational reason for being short. To me, if I were choosing between the two, I would choose the bear case, because we're starting to form a relentless series of lower highs and lower lows. Market continues to sell off, right? Trying to reverse up here below a lower low. The bulls are hoping it's transitioning into a trading range. Can they buy that? They can. I think the market's still always in short, and that we're probably going lower. Two-bar reversal, down on this bar, up on this bar. Micro wedge, 3 pushes down. To me, I think this is not a strong buy. It's not good enough for a major trend reversal. We're in a bear trend. If I am taking a long in a bear trend, I'm only going for a scalp. Initial risk is below the, if let's say you bought above the high of this bar or above the high of this bull bar, all right, you get in at this red line. Your initial risk is maybe below the low of this bull bar. So your initial target, 2 times actual risk, is up here. By the close of this bar, to me, I would be pretty uncomfortable going for that much of a target. I probably would start looking at actual risk. By the close of this bar, had I bought right there at that red line, 1 tick above the high of this bull signal bar, I know my actual risk was here, 1 tick below the low, okay, of my entry bar, and I would be looking to exit based upon actual risk. Okay, so if I got long on this red line at the close of this bar, I know my actual risk was to 1 tick below its low. 2 times actual risk is right here. So had I taken this long, I'd be getting out of at least half, probably all, right here at 2 times my actual risk. 2-bar reversal, 2 legs up. At the moving average, bear bar closing on its low. Bears could short here. In general, I might take that short. The upward momentum is enough, so I probably would wait to see if we go sideways and get a better sell signal. Maybe we'll get a higher low major trend reversal. But to me, I would probably not take that short. I would wait to see what plays out over the next several bars. And this is what we got, a triangle, 3 pushes up. We went up on this bar, went up here, we went up here. And then our bear bar closing on its low below the moving average. To me, this would be a reasonable short. You can argue a double bottom and a higher low major trend reversal. We have a bear trend, we have a bull break of the trend line, and we have a triangle or double bottom higher low. The bulls could take that long, betting on the swing up. I think it's an okay swing buy above that bull bar. For me, I would probably not take the long, and I probably would take the short, especially after the long triggered, because once that long triggers, I know there are bulls in the market who will get trapped if it reverses down. So I think that's a reasonable short for a swing down. Market selling off. I personally would not buy this. 5 consecutive bear bars and a bear trend. 2-bar reversal, up and down on this bar, up on that bar. Not strong enough for me to not strong enough to reverse that selling. However, at this point, I probably would consider taking a scalp. I probably would buy above the high of this bar. You could buy above this high. You have a wedge bottom, 3 pushes down, 1, 2, 3. Just trying to get some two-sided trading. Possible small final flag here, larger final flag here. Triangles often become final flags and magnets, and the market probably will try to get back up into the middle there. So I do think it's okay to scalp along here. I would be much more interested in exiting shorts, so I would get out there. Okay. I'm running out of voice, but the most important point I wanted to make today is that 95% of the time you can enter a trade from the long side or from the short side, and if you manage your trade correctly, you can make money, and that's what institutions are doing. If the market's trying to go sideways and it's clearly in a trading range, it's better not to be buying in the middle third of the prior leg. Instead, wait until it's below and then buy, and then when it gets above, then sell. Let me take a look at questions.
Hey, Al. Thanks for the presentation. I asked everybody to hold questions until the end, so I'm going to go ahead and ask everybody to go ahead and start typing and get those questions entered in now, and we can see how many we can answer.
Okay, I will try to keep up.
John wants to know, why don't you use volume?
Because, especially in the E-mini, volume is deceptive and misleading. Sometimes in my trading room, I'll put up a 1-minute chart and I'll say, look at that spider volume. All the prior bars had 200,000 shares, 300,000 shares, and this bar has over 1 million shares traded. The market, some institution just made a big bet. Also, sometimes I'll show the weekly options for the spider, and I'll say, look at that. Somebody just bought 7,000 calls, and the market's been selling, and now we have a single order with 7,000 calls. That's a big institutional bet that the market is going up. So I'll use volume in that instance. I'll also use volume sometimes just to illustrate a point. On the 1-minute chart in the spider, if we get like a wedge bottom and the ticks are less on the second push down and less again on the third push down, so we're trying to get a divergence in ticks. Very often there'll be a divergence in volume as well. So the first push down will have a big volume. Second push down, smaller volume. Third push down, smaller volume still.
Both Stephen.
If I'm looking at that at the time, a lot of times.
Sorry, go ahead.
A lot of times, if I see that, I'll just buy at the market. I had a friend 15 years ago. I used to trade with him online. I never met him, and all he did all day long was wait for tick divergences and volume divergences. He was interested in tick divergences, and if the market is selling off and he has a divergence and then a second divergence, like a micro wedge, he would buy 25 contracts. And I forgot if he was trying to get 1 point or 2 points, and he was taking 2 to 3 trades a day, and he was trying to make, he's trying to net about a point a day. So he was trying to make $2,500 a day on small tick divergences. To me, I'm just going off topic here. Sometimes I'll take that trade if I'm looking at the time it happens, but I much prefer it if there's also a volume divergence. There was that actually took place early today on the E-mini. There was
right.
a micro wedge with volume divergence and tick divergence, but in general, volume on the E-mini is totally misleading. If you look at it, I think you're going to get screwed.
Both Stephen and Jeff have a similar question. They say, how did you arrive at the 60% favorable probability number?
Nobody knows. Probability is the one thing that's always unknown in trading, right? All I know is that most of the time the market is pretty balanced, and so pick a number. Is it does that mean 60-40? Does that mean 70-30? I don't think it's 70-30. I think the market is usually not 70% certain. Just think of it during the day. If you're looking at the chart, how often are you 70% certain that the market is going to do something, right? I think most of the time it's closer to 50-50, 40-60. So that's why I use 60-40. It doesn't matter.
Right.
You can say 62%, 38%. You can say 45%, 55%. The important point is, if you're taking a trade and you're pretty confident that the trade will work, go for a reward at least 1 times your risk. Okay. If you're really not sure if the trade will work, go for a reward 2 times your risk. The 60-40 is irrelevant. It's more an issue of,
right,
am I confident, am I not confident? If you're not confident, go for a reward 2 times your risk, and that will result in a positive trader's equation. Whether or not the probability is 38%, 44%, it doesn't matter.
Right. That's very interesting, and I think that's counterintuitive for some people, because they'll think, lower probability, I need to lower my target. Dave says, do you have a different strategy when you're swing trading, or is it the same?
In general, if I'm swing trading, it's rare that I'll take a day trade with the intention of swinging the entire position. Okay. In general, on most days, I scalp most of the time. But a lot of the times, if the market is moving pretty well, I'll take half off at, let's say, 2 points in the E-mini, and then I'll swing the other half. Usually I'll take off 25% more at 4 points, and if, rarely the market will go 10 points, I always get out at 10 points. And if you look back over the past 6 months at any entry where the market went 10 points, you'll see that the market will start to get profit taking and go sideways, almost all of the time.
Right.
10 points, 11 points. That's because everybody's taking profits.
Right. Reese has a question. He says, do you draw trend lines using the tops and bottoms like the high and low, or do you use the open and close of the candles?
I use everything. 99% of the time when I'm drawing trend lines, I'm using highs and lows of bars, right? Rarely I'll look at other things, closes and opens, and I'll look at a high as kind of an outlier or spurious price. But most of the time, almost all the time, I just use highs and lows. I often use parallels. So if I'm looking for, let's say the market's going up, and I can see clear lows, and I can draw a trend line below, but I'm not sure that there's a good channel line on the top. What I'll do is I'll create a parallel of the trend line below and drag it above and anchor it to a high to generate the channel.
Right. Hugh asks, regarding the EMA 20 moving average, a lot of moves seem to revert back to the mean. Do you use that in your trading decisions?
I'm sorry, I didn't hear. You started talking about regression to the mean trading. If the market gets too far from the moving average, will I look to short?
Yeah, he just says, regarding the EMA 20, if it does fall back to the EMA 20 line, how are you using that information in your trading decision?
It depends on the situation. If let's say it's a bull trend, and it's a reasonably strong bull trend, the first pullback to the moving average, there are always buyers there. So I'm always looking to buy the first pullback. Linda Raschke, she used to call it her holy grail trade, and I don't know if she still does. I don't know if she still calls it that. To me, there's no holy grail in trading, but her point is good. If the trend is very strong and you get a pullback to the moving average, there'll be buyers there. So depending on how strong the trend is, that determines how I will buy there. If the pullback is very calm and two-sided, I may place a limit order to buy at the moving average. If the sell-off to the moving average is a sharp reversal, I probably will wait for a few bars and see what happens before I look to buy. But in general, I'll try to buy at the moving average in a strong bull trend.
Is there anything special or magical about the EMA 20, maybe like versus a VWAP or versus some other number?
No, I don't think it matters what moving average you use, and I don't think you have to use a moving average at all. Moving average is the only indicator that I use. I could use other indicators. I could use Bollinger Bands. I could use oscillators and everything else, right? And I could generate signals. I could use range charts, volume charts, charts based on ticks. It doesn't matter. I can, Renko charts. I can use any kind of momentum charts. It doesn't matter.
Right.
There are signals taking place all day long on every chart and on every indicator and on every time frame. And I miss thousands of signals every day on other markets. Right? I don't care. I do know that if I pick one chart and I work really hard to take trades on that one chart, I'll find enough signals during the day to make a good living.
Right. Master that chart.
I don't worry about everything that I'm missing. I just worry about what's in front of me.
Sorrel asks, do you have an opinion on, or do you have a formula or some type of way to determine the type of day early on, like if it's going to be a trend day or a range day or a trend reversal?
Yeah, I talk about that. Yeah, I talk about that in the course and in the book. I look at the first bar of the day, and if it's a small bar with prominent tails, at that moment I think the day will be a trading range day. If yesterday was a trading range day, and the past 5 days were trading range days, I think today's going to be a trading range day. If the first 3 or 4 bars are doji bars, with 2 or 3 reversals, I think today is going to be a trading range day. If the first 10 or 15 bars are in a tight trading range, I think today is probably going to be a trading range day. If, on the other hand, we have a big gap up above a resistance level and a bull trend bar closing on its high, and it's followed by another bull trend bar closing on its high, I assume today will probably be a bull trend day. Or on the other hand, let's say it's been in a trading range for the past 3 days, and then the first 4 bars of today are big bear bars closing on their lows. I'll assume that today would be a bear trend day. But most of the time, the first bar or 2 or 5 or 10 tell you a lot about how the computers are going to trade the day.
Steve asks, regarding futures, looking at the NASDAQ, the S&P, and the mini Dow, do you have a preference on which one is better for a beginner to start with?
I don't have a preference. I think of the 3, I think the E-mini is the most difficult to trade. The issue with the mini Dow is you have more slippage, right? And I don't think it matters which one you pick. I also don't think it matters if instead you want to trade stocks. A lot of stocks. If you trade a stock that, like a $20 stock, Bank of America, Citibank, you can get great trades on those. If you want another alternative, which I think is a good alternative for people starting out, you're going to lose money, for the first year or 2 trading. I mean, there's no way around it. You may win for 6 or 7 days in a row, or 2 or 3 months in a row, but you have to assume that you're going to lose money for the first year or 2, and that's your tuition.
Right.
You're going to school, trade school, to learn how to trade, and one thing you should be doing is trading real money, not paper trading, because you lie. We all lie. And then the other thing you have to be thinking about is, how can I lose the least amount of money and get the most amount of education?
Right.
And one way to do it, one good way to do it is look at weekly spider options, at the money weekly spider options. In general, if you trade one contract and you lose, and it goes 20 cents against you, you lose $20, right? And 20 cents against you, that's the equivalent of a 4-point move in the E-mini, right? So do you want to lose 4 points in the E-mini, which is $200, or do you want to lose 20 cents on a spider call, which is $20? So I think one of the nice things about weekly spider options is that if you're starting out, I think it's a great way to get practice real time without much risk. You can say, well, Al, how can I make much money trading weekly spider options? Well, that's not your goal. Your goal is to not lose much money until you learn how to trade.
Right.
And even if you do learn how to trade really well, you could still trade spider options forever.
Sure.
I can tell you from personal experience, you can trade hundreds of spider options at the market and get really good fills, right? So you can handle as much volume as you can throw at them. So
Vance wants to know if there was one single attribute, the single biggest attribute for successful price action trading, what would it be?
I don't care. And that's the reality. If you want to be able to trade price action, you've got to be objective, and the best way to be objective is to not care about the result of your trade. All right. If you take a trade and you say, "Oh my gosh, I lost the past 2 trades. I lost 3 days this week. My wife is going to get really mad at me. She's going to make me quit." Right. If you care, you will not be objective, and you will lose money. So you have to trade small enough so that you really don't care. If I lose, I don't care. I can be objective on my next trade. I don't care if I lose 5 in a row. It's not going to be that much money. All right.
Right.
So until you get good, even when you're good, I still think you have to be trading the I don't care size. So you trade small enough so that you really don't care if you lose money, and that way you can feel comfortable and to do the right thing. You always got to be doing the right thing. Always, always, always have to be doing the right thing. Is what I'm doing sensible? Is it mathematically sound?
Andy wants to know, have you ever tried to automate your trading methodology?
Yes. Yes. For years, I probably spent 20,000 hours, writing systems and testing systems. I haven't done it in over 10 years, but I spent a lot of time doing it, and I have tried automating trades. And what I learned is that I'm extremely compulsive, extremely controlling. I have a whole bunch of traits that aren't good for automated systems. Right? Every time the system would put me in a trade and it starts to go my way or go against me, I start looking about all the exceptions. I could have programmed this one little filter in there, so I would not have taken this trade, or I would have gotten out a little bit sooner or a little bit later. So I don't have a personality that's suited for that. It's very important in trading, I think, to be trading within your comfort zone. And I don't care if there are traders out there who are great computer traders. I don't care if there are traders out there who are really comfortable taking low probability trades where the reward is much bigger than the risk, and they get rich, right? That's not my comfort zone. I want to be doing this long term. I've been doing it for 25 years, and happiness is very important to me. And I just, a lot of your trading, especially early on, is trying to figure out where you're comfortable. I remember years ago, 15 years ago, 20 years ago, when day trading was beginning, you'd have the institutional traders saying all these terrible things about day traders, like we're the scum of the earth, and I used to feel bad. And over time, I came to accept that the goal of this business is to make money, and it's hard to make money doing this. And if institutions are making money, great, good for them. Well, guess what? I scalp a lot, and I make money, and good for me. And I don't care how anybody makes money as a trader. If they're making money as a trader, I think that's great. And I think nobody should be embarrassed about their style of trading, and no one should worry about somebody else's style. Oh, I saw this guy on television, and he's doing blah, 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 and if I don't do that, I'm not good. That's not true. Right. There are tons of ways to make money trading, and as long as you find one that suits your personality, don't worry that you're not doing what somebody on television is doing, or what you read in a book, or what you heard in a webinar. You got to be doing something that suits you. You got to be comfortable doing this. If you're trying to do this for a career, it has to be fun. So you got to find a style of trading that's fun. When I get up in the morning, I can't wait to turn the computer on and get to work. I love it. It's a lot of fun.
Right. Steven says he's a beginner and he's read all 3 of your books. I'm going to assume that's your new 3 books. But he's not profitable yet. And as suggested in one of the books, he's trading 2 contracts. The first one for a point, and then moving the stop to break even and closing the other contract at a resistance or measured move. And he wants to know, is this still the best idea at this stage of his trading?
If he's starting out and he's not profitable, I would not be trading 2 of anything. I would be trading 1 contract, and I would only be going for a reward 2 times the risk, and I would be very selective about what I'm trading. And I would also, instead of trading E-mini, if that's what he's doing, I would switch to another market. For example, what I like would be weekly options in the spider.
Right.
And just trade small.
Something cheaper.
It's just cheaper. I would just trade 1 contract. And again, you can say, well, I can't get rich doing that. That's not your goal. Your goal is to learn how to trade. And it doesn't matter what path you take to achieve that goal. And to me, I want to take a path where I'm losing less. So weekly options, or a cheap ETF, low-priced ETF, or a high-volume stock, Bank of America.
What I found is that a lot of people, though, they start losing, whatever. It doesn't matter if it's months or years. Then they have this built-up loss, and they're kind of unwilling to reduce their size or change their market because they feel like, well, I'm never going to make it back. And
right. How can I ever make it back?
Right. The goal is to stop the bleeding. That's step 1, right?
Yeah. To me, the money is no longer yours. Once you've lost it, it's somebody else's money, and you can't be worrying about somebody else's money. All you can do is go forward and do what is best for you at the moment. and not worry about the losses. And
Right.
I would try hard to start doing the right thing as soon as I possibly could.
Right. Mike has a question. He says, can Al elaborate for those who have read all of his books on what the differences are or the advantages to subscribing to the online video trading course?
From the books, I think it's a matter of personal preference. Some people like books. I'm an old guy, so I tend to like books. I can quickly page around through stuff. Other people like videos. The videos have a lot more charts, which is good if you really like charts. The books have a lot more text, which is good if you really like books. I've had a lot of emails from people who have read books and watched the videos, and I've not yet had one say that he prefers books over videos. So it appears to me that most people prefer the videos.
Right.
But recommending one way or the other, I don't know. I have 4 sample videos on the website, the Brooks Trading Course website, and one of the videos is one of the 53 videos in its entirety. And also, I give a money back guarantee on the videos. So if somebody buys the videos and say, I don't like this stuff, I'll just give you your money back. So there is a way to check the videos out, either with the samples or simply by buying it and asking for a refund.
Right. And see if you like it.
To let you know, if it works for you.
Noah says or asks, can Al give a brief explanation as to the exact difference between a stop order and a limit order, and why one would use one versus the other?
Okay, let's say we have a bull bar, and I'm looking to get long, right? I could place a buy stop 1 tick above the high of that bar, and if the current bar gets 1 tick above the high of the prior bar, I'll get stopped into the market. My stop order will be filled, and I'll get long. So the market is going up, and I'm buying as it's going up. So I'm betting that the market will continue up. On the other hand, let's say that signal bar did not look all that strong, and the context was not all that strong for the market to go up. Instead of buying on a stop at 1 tick above the high of that bar, I might place a limit order at the high of that bar, a limit order to go short. So my limit order probably will not get filled unless the market goes at least a tick above the high of that bar, because limit orders usually do not get filled unless the market goes through them. So if I'm bearish, I'll place a limit order at the high of that prior bar, betting that if the market gets up there, the attempt to go up will fail and the market will reverse down. And that's that slide that I showed earlier, where if the market is going mostly sideways, let me see if I can find it. If the market's going mostly sideways, I don't want it right here, okay? Okay. Just look at what happens to the stop order traders. Let's say you sold on a stop 1 tick below this bar, or 1 tick below that bar, or 1 tick below this bar, or 1 tick below that bar. You lost money. That means the limit order traders made money, all right? So that's a perfect example of a limit order market. When I think the market is going to be mostly sideways, and if I'm going to trade it, I'm going to place a buy limit order at the low of the prior bar, and I'll get filled right here, right? And then I'll scalp out, right? And I'll place sell limit orders above the highs of prior bars. So instead of buying on a stop 1 tick above this bar, right, and getting filled right there, long, instead I'll place a limit order at the high of that bar. So when the market gets 1 tick above the high of this bar, right here, I'll be getting short for a scalp down. So if I think the market is mostly sideways, I don't want to be buying on a stop above the prior bar or selling on a stop below the prior bar, because I think there will not be follow-through. The breakout below the low of this bar, I think it's going to fail, and the market will reverse up. Above this bar, I think the market's going to fail, and I think it's going to reverse down. So I hope that answers the question. So either, a limit order is the opposite of a stop order.
Right. Let's do one final question, since we're running up against an hour and a half already, and Al is at a coffee shop, and we still have to do the book giveaway. So last question. Andy says, Al, how long did it take for you to become consistently profitable?
Over 10 years. It took a long time. And, I used to wonder, should I ever tell people that? That's embarrassing. It makes me sound like a jerk. How can I do this for 10 years and lose money for 10 years? But that's what it took me. It took me that long before.
Well, knowing what you know now, is there a way that you could cut that time down?
Well, I think most traders would not take that long, right? For me, it took that long because of the circumstances of my life. I started trading, a couple weeks before the 1987 crash, and then in 1989. I had one daughter in 1988, and then identical twin daughters 15 months later. So I had 3 daughters under the age of 15 months.
Right.
And that became a huge, that consumed so much of my time. So there are all kinds of, everybody's life is different. Plus I had all kinds of personality issues that I had to deal with. I had to find my comfort zone. I had to fight what the media was telling me about what a trader should be doing.
Right.
I had to fight through all the literature. Anytime you look at an article, it's just filled with all these indicators.
Right.
And I was trading using them, thinking I was doing all the right things. I went to medical school. I practiced medicine for 10 years. So in medicine, the rule is you do what everyone else is doing. In trading, the rule is you ignore what everyone else is doing and you do what you think is right.
Right.
So it took a long time to change my mindset. And about 10 years out, I decided I was going to get rid of all my indicators and just pick one chart and look for signals at the end of the day that make sense, and then add indicators back in. And what I discovered was I started making money consistently without the indicators, just looking at the charts. And since then, I never bothered with the indicators again.
I'm going to guess that during those learning years, you were probably changing things all the time, and that's something that I see. Right, I see that on the forum. It's a very distinct, very noticeable pattern that the newer traders are constantly changing. I mean, if they have a journal, which is already fantastic and a leg up against most people because they don't. But if they have a journal, then it's like every other day their chart is entirely different. It's because they'll have a losing trade, right? And then they'll think that it's because something was wrong with their chart, something was wrong with the indicator, something was wrong with the signal generator, so they go find a new one, right? And it's
let me say one thing about that changing.
Yeah.
Okay. High frequency trading firms, a lot of them lose money, right? But a lot of them make a lot of money, and the ones that make a lot of money, I think the majority of them are using algorithms, and then every week or two they stop using an algorithm. So they're constantly changing according to the character of the market, right? So there's nothing wrong with changing all the time, but because the high frequency trading firms are doing it constantly. They're constantly changing with the market, and I constantly change with the market as well. When the market looks like this, I'm trading much more with stops. When it looks like this, I'm only trading with limit orders and at the market. So I'll buy the close of that bear bar. I'll sell the close of this bull bar, right? Whereas if it was over here, I would be doing the opposite. I'd be buying above bull bars and I'd be selling below bear bars. So yeah, I change based upon the price action.
That's why I'm a discretionary trader, because I need that ability to adapt, the ability to make my own decision, Okay, so Al, we're at an hour and a half, and I know you're outside your house, so I want to thank you for your time, as always, and the time to answer everyone's questions. There were over 100 questions, guys, so obviously we didn't have a chance to get everyone's questions answered, but stay tuned. We're going to do the 5-book giveaway, and if you want to get in touch with Al, there's 2 ways you can do it, right? There's brookspriceaction.com. That's his main website where he does his daily webinar, his daily room. And then his video course that he talked about is brookstradingcourse.com. Did I get that right, Al?
Yes, that's correct.
Okay. Well, thanks, Al. And everybody else, stay tuned, and we're going to give away some books.
Okay. Thank you, Mike. Appreciate it. And thank you, everyone, for listening.
Thanks, Al. Talk to you later. All right, guys. So before I do this, let me take control here. Okay. I want to remind everybody that the way I'm going to get in touch with you if you are one of the 5 winners is on BMT. So if you don't already have a BMT username, just go to bigmiketrading.com and register real quick. It takes less than a minute. And then that way, if you're one of the 5 winners, you can give me your BMT username, and then I'll contact you and I'll get your mailing address and any special autograph or anything that you want, and then I'll coordinate all that and get it over to Al. All right, guys, so the way that we do the prizes here is in order to keep it fair, we have 5 books today. So the first question, whoever answers correctly first wins. And then let's say that by the time we get to the 3rd question, it's whoever answers 3rd in line correctly. So we're looking for the 3rd correct answer. That person wins. And then for the 5th book, I'm looking for the 5th correct answer. So that way it's not just whoever's got the fastest connection or whoever can type the fastest. It's kind of fair that way. All right, guys, so let's get started. Everyone can see the screen, yes? Okay. Oop. There we go. Question 1. If you're not certain if an E-mini setup is strong, what is your target? I'm looking for the first person to answer correctly. Okay, guys, we have the answer, so stop typing, please. There's about 300 people here, so the screen kind of flies by. All right, let me go back and find. All right, so the correct answer is 2 times actual risk, and the first person that got it correct is Brian Zimmerman. So Brian Zimmerman, if you would give me your BMT username, please. Okay. Going to question 2. In a bull channel, what is needed to short? Okay, we have the right answer. So guys, I'm going to ask you to stop typing so my screen can stop flying by. All right, so the correct answer is adequate selling pressure. And let's see, the second person that got that correct is let's scroll down. John Mooney. John Mooney, I need your BMT username, please. Okay. All right, going to question 3. So we're going to be looking for the 3rd correct answer. Most major trend reversals lead to okay, guys, we have the answer. The answer is small winners or losers. Now I just need to figure out who the 3rd person was. There's a lot of them here, so hang on, please. All right, so small winners or losers, looking for the 3rd person that answered correctly. There's the first. There's the second, and there's the 3rd. Steve, ST. That's an abbreviation, I guess. Steve, I need your BMT username. So the answer was small winners or losers. Okay. Going to question 4, so we'll be looking for the 4th correct answer here. If the actual risk of a long is 7 ticks, but the probability looks good because it is a second entry with a good signal bar, what is my minimum profit target for a positive trader's equation? Looking for the 4th correct answer. And okay, guys, we have it, so please stop typing. All right, so the correct answer is 7 ticks, and I'm looking for the 4th one, so give me just a second, please. All right, 1, 2, 3, and 4. James Hode, I need your BMT username, please. Okay. All right, fifth and final. Looking for the fifth correct answer. What are reasonable trades in a strong bull channel? All right, guys, we have the answer, so you can go ahead and stop typing, please. The correct answer is all of the above. And now I just need to find the fifth person. There's 1, 2, 3, 4, and 5. Mike DeLusa, I need your BMT username, please. All right, guys, so congratulations to the winners. And, okay, thanks, Mike. And I'll contact you on BMT in a few minutes via private message. For everyone else, I'll be posting the recording on BMT sometime tomorrow. It'll be in the usual spot. You just click on webinars at the top of any page. If you don't see it, then just check back later. It'll be there eventually. I'll also send it over to Al tomorrow so he can post it on his website, brookspriceaction.com. All right, guys, I'll see everybody on the forum.